Today our topic is your move to Canada, cross-border real estate, presented by Canadiana Fest and myself, Shannon Mondu, and we are with Sonia Dolgina, Shala Bakar, and Carly Shee. And we're glad to have every single one of you here today. I'm going to introduce everyone. This is Sonia Dolgina. She's a CPA and also licensed in Illinois, so Canada and US. She's a cross-border tax advisor based out of Vancouver, BC, as I mentioned, and she works in wealth management as well. She is the co-author of the best-selling book, Your Move to Canada, which I have read, and I can't find because I'm having some painting done in my house, but I've read it, and it's very well written, and she explains these topics, very difficult topics, very well. I highly suggest you get it. Sonia has a decade of experience advising families on the financial and tax implications of moving between Canada and the US, including impacts for investments, retirement accounts, and real estate. Fun fact, Sonia has an 8-pound toy poodle named Lily, who has climbed some of the most treacherous hikes in British Columbia, including the Squamish Chief, which I have been on. I attest to its difficulty, and Mount Gardner on Bowen Island. I've never been there, Sonia, so maybe when I come and visit British Columbia next year, I'll come and check it out with you.
Lily will take you up.
Lily will take me out? Okay, thank you, Lily. That would be adorable. I don't have a dog, so I live vicariously through other people. All right, and next is Shala Bakar. She has her bachelor's of, she's an attorney, and she has a BA. These are some smart ladies we have here today, folks. Shala is one of Vancouver's most trusted real estate advisors and ranks in the top 1% of Greater Vancouver realtors. That is saying a lot. Shala comes with a team of experts for every step of your home purchasing journey, including inspectors, immigration and tax lawyers, financial advisors, movers, handymen, contractors, painters, landscapers, everybody. And she makes sure that the home purchasing process is handled with the utmost professionalism for the best results. Shala has successfully helped many people and their families relocate to beautiful Vancouver. Her education and experience as a University of British Columbia educated lawyer sets her apart from her colleagues. Her in-depth and highly specialized real estate knowledge offers, contracts, and negotiations is invaluable. I can imagine it's so complicated. And this is an asset to both buyers and sellers, especially when navigating a cross-border move. And her fun fact is that she loves plants and animals, and she has an adorable cat named Paisley, who's queen of the house. Aren't they queen of everything? And she has 50 plants. You are a busy lady. Next, we have Carly Shee. She is a mortgage consultant based out of Vancouver, British Columbia, with 20 years experience. She started when she was 12. She arranges residential financing through banks, credit unions, and specialized mortgage lenders. She works with first-time homebuyers, homeowners, real estate investors, and retirees. While she primarily serves clients in British Columbia, her broader team can assist with residential and commercial mortgage options across Canada. Carly's fun fact is that she speaks Dutch, incredible, and enjoys tracing her family history through genealogy and research and archived Dutch newspapers. I'm going to take a moment here to go over to the page. Actually, I can't let anybody in with this screen up. Sonia, are you able to let folks in?
I don't have that ability.
Okay, I have to stop my screen share for a moment.
Yep.
And then we will restart this. I apologize, everyone. I will admit all, and then we'll get right back to it. Okay. And at some point, it'll just end up being, they'll just have to get the recording. So, but let me go back down here to the share. All right. So, Carly, I wanted to tell you, I happen to live in an incredibly Dutch area of.
Is that right?
Yes.
Oh, incredible. Lucky you.
Very large and a large.
Great food.
My first boyfriend was Dutch too.
Is that right?
I love the Dutch people. I really do. I love the fact that they wash their sidewalks. I mean, that was
Oh,
blew my mind. But
I
how
hope you
wonderful.
have. I hope you have lots of Dutch restaurants around you too.
We have a few. There's a place called
Like,
Holland right up from me in Michigan that is really an incredibly Dutch town. So if you ever come to Michigan, you'll have to come check it out.
fantastic.
Well, let's learn a little bit about me now, of course, because I haven't spoken enough. I am Shannon Mondu. I'm the creator and director of Canadiana Fest, a grassroots, multifaceted Canadian cultural organization that hosts numerous varied events supporting the Canadian diaspora, like this, and allies, culminating in the Can-Am Peace Jam in the fall. I'm also a chef. I teach at Western Michigan University. I'm a former program administrator at Revenue Canada, or Canada Revenue Agency, and I was also at one time a chartered personal risk insurance advisor and banker. So I've had quite a varied life. Fun fact, I competed on Food Network in 2007 on the Ultimate Recipe Showdown. And no, I did not win, but I did pretty good. So I had a great time going to Hollywood and meeting, oh, jeepers, drivers, diners and dives, whatever that guy's name is, and had a lot of fun. So today's agenda, why we're all here today, um, Sonia is going to cover tax implications of your US home, tax implications of your Canadian home. They're different, two different, very different countries. Shala is going to handle process of buying a home in Canada and Canadian housing market and rules. Carly is going to follow that up with mortgages in Canada, avoiding the pitfalls, finding out what the differences are, and a general rule of thumb. So after that, we're going to wrap it up. We're going to have questions and answers, and we're going to have a lot of fun with this. All
All
right.
right.
So, um, Sonia, take it away.
Thank you. Yeah, before I get started, I just wanted to shout out that I have previously done a webinar focusing on tax and financial implications of moving to Canada. And it talks more about retirement accounts and pensions and investments, and it kind of dives deeper into tax residency. So I do suggest if you haven't seen that one to watch that one too. We got a lot of questions in the intake form for this event asking about investments and pensions and social security and things like that. So a lot of those questions could be answered. So if you just go to canadianafest.fun under past events and webinars, you'll see that there. And then this recording will be on that website too within a few days. All right, so I borrowed the next slide directly from my last presentation because it was so important. Because everyone needs to understand the or the implications of being a tax resident and what tax residency really is. And it's a great starting point and it's crucial for real estate. So there's a myth that your Canadian tax residency is related to your immigration status. People think they moved to Canada, they're not a permanent resident yet, maybe they're here on a visa, and that they're not tax residents. But that's not necessarily the case because your immigration status and your tax residency status are actually separate matters. They're not very closely related. Generally speaking, tax residency is based on your residential ties to Canada and your intent. So things like if you move to Canada and you now have a home that's either leased or owned, and then if you have a spouse, dependent children, the intention of living in Canada as opposed to just visiting. And we'll refer to tax residency throughout my section of the presentation. So it's important that you understand what this day is. Oftentimes, if you're making a one-way move to Canada, it's generally the date that you became a Canadian tax resident. And Canadian tax residents are taxed on worldwide income and subject to the same tax rules as Canadian citizens who lived in Canada their whole life. But as Shala and Carly will go over in their part of the presentation, when it comes to buying real estate, your immigration status definitely does matter. So some things to keep in mind. All right, so we'll go to the next slide. So one of the top questions that I get is, what happens to my US real estate? What happens if I sell my US property after moving to Canada? Is Canada going to tax everything? So we'll go over all of that. So the first things first is when it comes to your capital assets, say your investments in like taxable brokerage accounts and US real estate, you want to understand what your cost basis is. And your cost basis is important because if you sell that property after becoming a Canadian tax resident, you'll have a capital gain. And a capital gain is generally the difference between your proceeds and your cost basis. So the good thing is in Canada, when you move to Canada and establish tax residency, your cost basis of the assets that you move to Canada with is generally the fair market value as of the date you became a tax resident. So say you bought your home for 250,000 US dollars, it was worth $500,000 US dollars on the date you became a tax resident. That $500,000 is the relevant amount for your Canadian cost basis. And then you have to convert it to Canadian dollars using the exchange rate on the date you became a resident. So that's a good starting point. We'll kind of go off of that. But your US cost basis, so for US capital gains purposes, that doesn't change. So you have now two separate cost basis amounts to keep track of. And also people ask, well, how do I come up with this cost basis amount? So the Canada Revenue Agency, CRA, our tax authorities don't necessarily indicate a specified way that you need to come up with this amount, but generally it's a good idea to get a valuation done, an appraisal by a real estate professional, or you could even document comparable fair market values, comparable recent sales. You just want to have a figure that you're able to defend if the tax authorities ever ask any questions. And then also there's a form called T1135 in Canada that is like a foreign asset disclosure form. There's a exemption for the very first time you're a tax resident from filing this form. Otherwise, if you exceed a certain amount of assets, you have to disclose it annually. That can include US real estate if it's income producing. So, for example, if it becomes a rental or investment property, you have to disclose the cost basis of that home. Otherwise, there could be big penalties if you don't report that form if you need to. But if the property is strictly personal use, then it is not disclosable on that form. All right, next slide. So what happens if you sell your property? So just because, again, you have to disclose the sale on your Canadian tax return if you sell the property after moving to Canada, doesn't necessarily mean that Canada is going to impose a tax. So we have to look at how is the capital gain actually calculated for Canadian purposes. It's your proceeds of disposition, so whatever you sell it for in US dollars, convert it to Canadian dollars on the date of sale, minus your cost basis, which again is the fair market value as of the date you became a tax resident, minus outlays such as realtor commissions and legal fees, all converted to Canadian dollars. So oftentimes, if someone closes on their property very shortly after moving to Canada, as long as the property didn't increase in value substantially, there might not be any capital gain. Because again, it's really based on the increase in value. But currency fluctuations do play a part in this because everything is reported in Canadian dollars. So, for example, say it was worth 500,000 Canadian dollars as of when you arrived in Canada, but then it didn't increase in value in US dollars, but say due to the currency fluctuations, it ended up being worth 550,000 Canadian dollars when you sold it. That might trigger a capital gain. Previous slide. Sorry.
Sorry about that.
That's okay.
Did I bounce? It did.
We could just go back.
Yep, I am just, there we go.
Perfect. So oftentimes you don't necessarily have to worry about a gain. Even small currency fluctuations that could result in a gain oftentimes are eliminated because you're able to deduct realtor commissions and legal fees. And then let's say you do have a capital gain because the property did increase in value during your Canadian tax residency period. Capital gains get special tax treatment in Canada where only 50% of them are taxable at marginal tax rates in Canada. And if it's a joint property, if it's a property owned jointly with your spouse, 50% of it is reported on each spouse's tax return. In Canada, we do not have joint tax filing. Each individual files their own tax return on Schedule 3. So next, how about if you sell your US home as a Canadian tax resident or just in general? So in the US, you have something called a primary residence exclusion. And it's very powerful because you're able to exclude up to $250,000 per individual from capital gains taxes in the US, so $500,000 if you file jointly. But what's really important to remember if you're moving to Canada and you're holding on to your home is that there are tests that need to be met in order to use those exclusions. And that is, you generally had to have lived in the home for at least 2 years out of the last five up until the date of sale. So that means if you're moving to Canada and you're not going to live in that home anymore, but you're just holding on to it, or maybe you started renting it out, you generally have to sell it within 3 years in order to exclude up to $250,000 or $500,000 from capital gains taxes. So very, very important to remember that date because let's say you sold it to 2 years and 11 months after using it as your home versus 3 years and 1 month. That could be a difference of tens of thousands of dollars potentially in taxes. There are partial exclusions available if you don't fully meet this test. For example, if the move was related to work or health related, or IRS has a list of criteria that allow for some partial exclusions. But for the most part, you just want to keep that in mind. And then any gains that aren't sheltered by that exclusion are generally subject to federal taxes. And then if the state that it's in has state taxes, it could be subject to that too. Also, there's something called NIT, which is an extra Medicare tax of 3.8%, which can be subject to taxes as well. If you are selling a rental property or what became a rental property, generally in the US, you claim depreciation expenses. Oftentimes, that is also added back to income for tax purposes when you actually sell the property. And then foreign tax credits are generally available. So let's say, for example, you sell your US property as a Canadian resident and there's a Canadian tax liability because there's a gain for Canadian purposes and then there's also a gain for US purposes. Now you're looking at two tax bills on the same gain. Luckily, Canada will allow for a foreign tax credit based on your US tax liability, your federal and state tax, so you're not double taxed. So that is an important matter. Next slide. Another one that I commonly get asked is FERPTA withholding tax. This is a non-resident withholding tax. So people think that, oh, am I subject to this tax on the sale of my home if I sell my US property after moving to Canada? The answer is this one depends on your immigration status because this tax is specifically for what the US labels as non-resident aliens. Non-resident aliens so US citizens and green card holders are never non-resident aliens. You are a US person for tax purposes. Or if you are a resident, if you don't have those statuses, but you reside in the US, then you are generally not a US non-resident alien. So if you are a US citizen, green card holder, you don't have to worry about this. Otherwise, if you sell your US property and you're considered a non-resident alien for tax purposes, there may be withholding tax on the proceeds. It's generally 15%. It may be reduced to 10% if you could see on the screen there if it's between 300,000 and a million and the buyer is going to use the home as their primary residence. If the home is less than $300,000 and the buyer will use it as their primary residence, there's no withholding required. So, and what does this really actually look like in practice? In practice, let's say sometimes we have mixed marriage, and by that I mean one of the spouses is a US citizen, the other is not. They come to Canada and then they sell their home. You have to look at each spouse's status. So if it's the property is jointly owned, let's say one of the spouses is a non-resident alien, they sell, then the withholding might be required on their half of the gain. And then some people say, okay, well, how do I avoid this withholding tax? Well, you could talk to your advisor, talk to your lawyer and say, okay, well, if it's not feasible for me to sell my property while I am a US person still, can I potentially transfer the ownership of my property to my US citizen spouse while I'm still in the US? So then when the property is eventually sold, it's not sold by a non-resident alien. So that is one potential technique. I also got a good question about this form called 8288B. So the IRS allows you to file this form to elect to have a lower withholding tax if you're ultimately not going to be subject to that full amount of tax. The issue with this form is you have to wait to get the approval from the IRS until you can get that tax released from escrow. But it could take up to a year for the IRS to actually process that form. And
Wow.
that was, the IRS, like, as I'm sure everyone knows, they're decimated a lot of their workforce. They say on their website it could take 90 days. I have heard in practice it could take up to a year to get this approval. So a lot of accountants actually don't recommend filing that form because even if you have the FERPTA withholding tax on the sale of the property, you can still recover that tax by filing a US tax return. So let's say, for example, you sell the home with, let's say, $100,000 is withheld, but ultimately the entire gain was excluded from tax due to the primary residence exclusion. You file your tax return, you get the $100,000 refunded by the IRS. Ultimately, it's a cash flow, timing, administrative hassle. Um, it doesn't actually change your final liability, but it's just some cash maybe kind of held up for a bit. Next slide. Got a lot of good questions as well about renting out your US property. What does that look like? So, as a Canadian tax resident, you have to report worldwide income. That includes rental income. So, that includes revenue from your US property and expenses, all converted to Canadian dollars. If you're renting out for the entire year, generally you would convert it using the annual average exchange rate uh, published by the Bank of Canada. So you're able to, it's not like you're paying Canadian taxes on the entire revenue. You're paying it on income. So I have a list of deductible expenses. It's generally the same for Canadian and US tax purposes. Again, if you're renting out that property in the US, you also have to report that income in the US. If you have a tax liability in the US because you have a profit at the end of the day after all your expenses, you can claim a foreign tax credit on your Canadian tax return to offset the Canadian liability so you're not double taxed. And I previously brought up that form T1135. That's a foreign asset disclosure form. Just a reminder, if you have a US rental property, it has to be disclosed to the Canada Revenue Agency. Um, Next slide. So, holding structure tax woes. So we got a few questions, I think one by Nikki about what happens if I hold my property in a revocable living trust or US LLC? So these are very common structures in the US, and they can oftentimes are considered disregarded entities, which means you don't have any separate tax filings, you don't have any separate taxes for these. It's just for, liability protection, estate planning, but there's no, but it's really simple from a US perspective. But unfortunately, for Canadian tax purposes, they don't recognize the disregarded entity of these structures, which means your revocable living trust, if it's managed by who becomes a Canadian resident, now can become a Canadian resident trust. Your US LLC is, in the eyes of the CRA, is not considered a disregarded entity. It's considered a separate corporation. And there's a lot of, I won't go into it in detail. I go over it a little bit more detail in the other webinar about the issues with these structures for Canadian residents. What a lot of people end up doing is, given all of the issues, they actually end up moving assets out of these structures. Always make sure to get your own tax and legal advice on that. But if you want to avoid Canadian tax issues, ahead of moving to Canada and you have real estate held in these structures, what a lot of people do is they move the assets out. If your revocable living trust and LLCs are taxed as disregarded entities from a US perspective, generally there's no tax implications of retitling the property and moving it out of those structures. Also, Canadian corporations for Americans, if you're a US citizen or green card holder, that can also result in US tax issues. They're Oftentimes, when it makes sense for an American to incorporate it is if you're operating an active business, for example, and you're earning a lot of money in that business, then it could potentially make sense to incorporate. It could still have some tax savings. Oftentimes, I'm working with physicians who are planning with that. But for rental properties, it might end up costing you more than the benefit you're getting, especially since, generally speaking, rental income is passive income, not active income, which the active income is where you get a lot of benefits for corporations. All right, almost done with my section. The IRS is still watching. So again, my previous presentation goes into this a lot more detail. So Oh,
Sorry
let's go
about
back.
that.
Yes, that's okay. So if you're a US citizen or green card holder in Canada, let's say you sell your Canadian real estate down the line. Now we're looking at, okay, you're settled in Canada, you own a home. What do you need to be aware of? If you sell that home, the IRS still needs to know about your gain. So you still are limited to $250,000 of gains that are tax-free from the US perspective, or if you filed jointly 500,000, but that's in US dollars. So what is maybe a $300,000 gain for Canadian purposes might be less than 250,000 USD after we do the currency conversions. The US also has a very pesky little rule when you settle foreign currency denominated mortgages, where if you do the math and you paid less in US dollars than the original value of the loan, you might have a capital gain for US purposes. And that's if you like sell your property or, make a large prepayment towards a mortgage. Um, but unfortunately, if you have a loss, you can't deduct it. So the IRS isn't very nice there. um, Change in use rules. Again, in Canada, if you changed the use of your property from personal use to rental or rental to personal use, there may be something called a deemed disposition where you're deemed to have sold it for Canadian purposes, but the US doesn't have this rule. So if you're not careful, if you don't get proper advice, if you don't file various treaty elections, there could be double taxation. So just keep that in mind. Anytime you change the use of your property, get advice. And then, sorry, let's just go back first. And then expatriation tax. So a lot of people ask about, okay, what if I give up my US citizenship, green card? This isn't really only related to real estate, but just be very careful. You need to know if you're considered a covered expatriate, which if you're one of them is if your net worth is over $2 million, you could be subject to an expatriation tax, and that does include things like investments, retirement accounts, and real estate. All right, next slide. So general rules with Canada. So like I mentioned in the US, there's that $250,000 exclusion for selling your property. In Canada, it's actually unlimited. There are some rules to avoid abuse of this, like you can't continuously flip properties, there's a minimum holding period and whatnot. But generally, if you live in your home for a number of years and it was your principal residence and it's the only home you have as a principal residence, when you sell that home, you don't pay any Canadian taxes on the gain, no matter how big it is. So, as Shala and Carly can attest to here in Vancouver, some folks are selling their home for $2 million gains. They bought it for $100,000 a few decades ago, and now it's worth $2 million. They don't pay any taxes. That is one of the greatest gifts of the Canada's tax system. But you do have to disclose that on a form to the CRA, otherwise there can be penalties. So in the US, you could still deduct mortgage interest and property tax on you. So sorry, in Canada, you don't get any mortgage interest or property tax deduction on the on your primary residence, unlike you do in the US. But if you're in the US, you still can, if you're, sorry, as a US citizen or green card holder filing in Canada and you have a Canadian home, you should still be able to deduct your mortgage interest on your US tax return, but you just can't deduct Canadian property tax. And there are some limits and thresholds around that. And then also some people ask, okay, well, can't I use that unlimited principal residence exemption from the Canadian tax rules to exclude gains from my US property? The answer is sometimes in very limited situations. Generally, it's if that was your only primary residence, let's say you're renting in Canada, and you still have your primary residence in the US, then you may be able to exclude some of the gains from Canadian purposes if you used that home and used it as a home at some point in each year of ownership after moving to Canada. So again, complex rules, make sure you get professional guidance. But if you're using your home and you're still spending some time there every year, and that's the only home that you own, you may still be able to exclude some of those gains from Canadian taxation. There's no rules saying that the house has to be in Canada in order to use that principal residence exemption. All right, my next slide, which will be the last one. There's a few tax programs in Canada for first-time homebuyers that provide some tax benefits. And it's interesting, first-time home buyer, not to be taken literally. When people hear the term first-time home buyer, they think, okay, it's if I've ever owned a home before, I'm not a first-time home buyer. But it's actually not the case because in Canada, the way they define first-time home buyer for the purposes of these programs is that you didn't own a home or your spouse didn't own a home that you or your spouse lived in the current or previous 4 calendar years. And that includes a home either in Canada or US. So if you say owned a home 5 years ago, but since you've been renting and then you moved to Canada, you might still be considered a first-time home buyer. And then you could benefit from programs, First Home Savings Account, which is kind of like a health savings account, but for buying a home. It's really great. You can get a tax deduction, and then you can invest in it and then take funds out tax-free in Canada. You can borrow from your RRSP, which is like our equivalent of a 401k using a first home buyer's plan. And then there's also a tax credit available if you're considered a first-time home buyer. It could be up to about $1,500 that you can get in tax savings just for buying your first home in Canada. Again, if you qualify. All right, so that's the end of my section, and I'll move it on to Shala. Oh, you're just muted.
Great. Well, thank you so much, Sonia.
Oops, you're muted again there, Shala.
Oh, is that better
There you
now?
go. Yeah.
Okay,
You're
perfect.
in.
So I'm Shala, a little bit of background about myself. I've been a full-time realtor here in beautiful British Columbia for over a decade now. And before that, I was practicing law. So when negotiating a deal, writing contracts, explaining the fine print, that's where I feel most at home. And it's a real value add for my clients. So Sonia just took you over some of the tax implications. And over the next 15 minutes or so, I'm going to chat about the market. Is it a good time to buy? How the buying process works here in Canada and how it's different than the US, and if you're even allowed to purchase a home depending on your status and residency in Canada. And then we'll hand it off to Carly, who will walk you through the financing side of things. So the current market, this is the question I most get commonly asked, is it now actually a good time to purchase? So here is the candid answer. Prices across most of Canada have been softening for the past few years since 2023, when interest rates dramatically increased after the COVID lows, and 2026 is no exception. So CMHC, which is a Canadian Housing Corporation, has said that this summer prices are still declining, sales are down, and new construction have all eased back, and the national average is down a few percent. Declining demand and correspondingly declining prices have largely been due to higher borrowing costs, a significant cutback on Canadian immigration targets, slower population growth, and overall higher economic uncertainty that we're seeing given world economic events currently. An important factor to consider is Canada is not one single market, and market trends can vary considerably. For example, British Columbia and Ontario are the soft spots right now, especially in main metropolitan cities like Vancouver and Toronto. Ontario has seen around a 4% decline this year, and BC is a bit sluggish, but also holding up a bit better. On the other hand, Alberta and Quebec have kept much more momentum, and some newcomers to Canada specifically moved to these provinces before better housing affordability. All to say, the the Calgary market in Alberta behaves very different than the Toronto market in Ontario. So where you buy really matters, and having a trusted professional there. The housing product type also matters as well. Right now, condos are the softest segment of the market, especially studio and one-bedroom condos that have historically been mostly investor-driven, which means real negotiating room and a buyer's market, especially for these condos, and especially new ones in newer cities like Vancouver and Toronto. Townhomes, on the other hand, are a product type that are primarily owner-occupied and most popular with families, and they're the scarce middle option. So they've held their value up the best. And detached houses are the priciest segment of the market. However, land is finite, so this product is most supply constrained and likely in the long term has good appreciation potential. So my takeaway is that for most Canadian cities, it is a buyer's market right now, especially if you're looking for a condo or a home under $1 million. It's the most buyer-friendly window we've seen in many years. And in my view, one of the best buying opportunities we've seen in a decade. So the next slide. So working with a realtor and who pays for it. Now, this is one of the biggest surprises that many of my American clients who are moving to Canada is who actually pays for the buyer's realtor. In the vast majority of Canadian municipalities, the seller is responsible for all realtor compensation, including both their own realtor and also the buyer's realtor. How it works is that the commission comes out of the seller's proceeds and is split between the listing brokerage and the buyer's brokerage. How it works is before a seller lists a home, the seller and their own realtor agree on a commission structure. If there's a buyer's realtor, the seller's realtor and the buyer's realtor split that commission. However, if there's no buyer's realtor, the seller's realtor gets to keep 100% of the commission payable for themselves. So to you as a buyer, having an expert on your corner costs you nothing out of pocket, and there's no discount if you don't have a buyer's realtor. It's the same price to you. So that's often a surprise to many Americans, especially after the 2024 US commission changes, where American buyers now typically owe commission to their own realtor directly. However, in Canada, the seller is still responsible. So I highly recommend you have one because your realtor is really the quarterback of your entire move. For example, I coordinate with the entire team of professionals that is assisting you in your purchase. I send documents, property documents to your mortgage broker like Carly, connect you with reputable home inspectors, help you review documents and details, which is especially important when you're buying a condo or a townhouse because you're buying into a strata corporation. And I connect you with lawyers and notaries who handle your closing, arrange for your key pickup, connect with anyone else you'll need from movers, painters, contractors. My job is to make sure you're talking to the right person at the right time and that the process stays on track and goes smoothly. So next slide. So how the buying process actually works in Canada. So it is similar to the US in a lot of ways, but the vocabulary and a few steps are different. So I'll walk you through it in order. So number one, most important step is to get pre-approved first. This is especially important when making a cross-border move. You want your financing lined up before you start shopping so you know your budget and can move quickly when the right home comes along. I'll keep this short because Carly is going to take you through all the financing steps and how it works for newcomers and how your US credit history fits in. Next, once you find a home that you love, we submit an offer, which is called a contract of purchase and sale. This one document covers the important aspects of your purchase, including your purchase price, your deposit, your completion date, the day you get the keys, the included items like appliances, light fixtures, and all your conditions, which are also known as subjects in Canada or referred to as contingencies in the US. All of these details are contained in the contract of purchase and sale. Speaking of conditions, in Canada, they're called subjects. And the most three common ones are 1, subject to financing, 2, subject to inspection, and 3, subject to reviewing the property documents, including any strata corporation documents as well. You typically get a short window to fulfill these conditions, which is usually around 5 to 7 business days. So it's especially important that you're pre-approved because that's the one piece that's out of our control. Inspection and reviewing documents, we can do pretty quickly together, but the financing piece is very important. So essential to chat with Carly before. If you're buying a condo or townhouse, you're buying into a strata corporation. So during the same 5 to 7 business days, we review the property documents in detail. These documents will include minutes, the budget, financials, the rules of the strata, the Form B, and most importantly, engineering reports called the depreciation report. In these documents, we're looking for information on how the strata is maintained, any large building upcoming projects that could result in additional costs known as special levies, any litigation affecting the property, rental restrictions, pet restrictions. And this is exactly where an experienced buyer's realtor saves you from expensive surprises like a big building repair bill that you didn't know was coming. Our job is to do all our due diligence so you have all the information to make the most informed decision. Next slide.
I just wanted to add, Shella, that and everyone, that we are about 10 to 3 right now. So I can project that we are going to go over. Please know that we will continue the presentation and we will always leave room at the end for those questions that need to be answered. And again, just know that we are happy to go over to accommodate.
Great, thanks, Shannon. So now the next step is subject removal. So this is the real commitment point in your whole process. So once you're satisfied with your 3 subjects, which are likely inspection, financing, and review of documents, then we remove subjects and give the deposit. Once subjects are removed and the deposit is given, the deal is considered firm and the home is actually considered as sold to you. This is different from the US of being under contract, but still having room to wiggle. Once you have removed your subjects and the deposit has been provided, you're committed to purchasing the property. If for whatever reason you did not continue with the property purchase, you would likely lose your deposit. Regarding the deposit, it's typically 5% of the purchase price. It can be more in a competitive situation, but generally 5% covers the vast majority of cases. You pay it at the same time as when you remove subjects. So after all our due diligence is done and you're certain that you're proceeding. The deposit is typically held in trust by the buyer's realtor's brokerage and is credited as part of your down payment. So for example, if you're putting 20% down and you gave a 5% deposit, then at the time of closing, you would owe the remaining 15% plus your closing costs. Now, let's chat about timelines because sometimes this surprises people. From an accepted offer, we typically have the 5 to 7 business days to do our 3 items of due diligence of financing, inspection, and document review. And I have trusted professionals that can connect you with every step of the way. So for example, for a home inspector, I typically email you a list of recommended inspectors and you pick which one you'd like the most. Closing is commonly 30 to 60 days. However, closing is fully negotiable. It can be as quick as 3 to 4 weeks for a vacant home or up to 4 months for a tenanted property, because we have to follow the applicable tenancy laws in the province you're moving to, or somewhere in the middle of this time range for an owner-occupied property, depending on the seller and yours timelines. 2 quick terms. Completion day is the day that is referred to as closing. So that's when the money and title are actually exchanged. Possession day is the day when you actually get the keys, which is typically 1 to 3 days after you close on the property, depending on how it's been occupied. And finally, in Canada, closing here is done through a lawyer or notary. There's no escrow company like there is in the US. A conveyancing lawyer or notary handles the title transfer, the mortgage registration, exchanges the funds for the seller's title, and all adjustments like property taxes are also handled by the lawyer or notary upon closing. So next slide. So now, can you even buy? As an American, can you buy a property in Canada? First, let's go over the easy part. If you're a permanent resident or a Canadian citizen, the foreign buyer's ban does not apply to you at all, full stop. So if you're a Canadian citizen or permanent resident, you're in the clear and can purchase. So what is this foreign buyer's ban? Basically, it's a federal law and has been in effect since the beginning of January 2023. Initially, it was meant just to be for 2 years. However, it was then extended for another 2 years until January 1st, 2027, and is currently in place. A very important exception to this ban is people who enter Canada on a valid work permit. So work permit holders are largely exempt from this foreign buyers ban. And so many Americans entering Canada with a valid work permit can purchase a property in Canada if they fulfill certain criteria. In general, currently, if you have a valid work permit or other authorization to work in Canada, you need at least 183 days of validity remaining. So roughly around 6 months or more, and you can purchase a property. It is limited to one residential property under that exemption, but you can likely buy a home with a valid work permit. Let me also cover where this foreign buyers ban applies and where it doesn't. The foreign buyers ban only applies to residential properties with 3 or fewer units, and only inside bigger census areas, so larger cities and their surrounding areas like Toronto, Vancouver, Calgary, Montreal. Where does this foreign buyers ban not apply? So rural and recreation properties like cottages outside of these metropolitan areas, vacant land, commercial property, or any building with 4 or more units are generally exempt. So for example, Whistler is a ski community and is actually exempt from the foreign buyers ban. So many Americans purchase property in Whistler, so there are real options there available. My key takeaway for you is that if you have a valid work permit, the ban likely does not apply to you. That said, the penalties for getting this wrong are serious, so it is vital to confirm your specific work and immigration status and your particular work permit with an immigration or real estate lawyer before you write an offer, and I can certainly connect you with the right ones to discuss. Next slide. So what happens when this foreign buyers ban expires? So the current expiry is set for January 1st, 2027. As of December 2025, the federal housing minister confirmed the government is actively renewing the ban ahead of that date. They're reportedly considering a model where foreign buyers could potentially purchase new construction and vacant land, but would still be barred from buying existing properties. All to say, it's very uncertain at this time if it'll be extended. The case for keeping the foreign buyers ban in is really about affordability optics. The case against it, that the real estate market, especially in BC and Ontario, are softening and prices have come down. Basically, the takeaway is plan with today's rules in mind, not any political predictions. For now, presume the buyer stays in place and rebuild your plan from there, checking your eligibility to purchase a property before writing an offer. Next slide. So mixed status couple, titling. Here's a situation that comes up a considerable amount, so I'll touch on it quickly. Mixed status couples. So Sonia went over this briefly, but say one spouse qualifies to purchase a property since, for example, they're a Canadian citizen or a permanent resident or hold a valid work permit, but the other spouse is considered a foreign entity and is not exempt. A common approach is to put the title in the qualifying spouse's name only at the time of purchase, and then add the other spouse later once they're no longer considered a foreigner. In BC, spousal transfers can qualify for property tax exemptions, but it really depends on the timing and residency status. So this is exactly the kind of thing that we plan ahead by chatting with a lawyer and tax specialist like Sonia before you purchase. One important caveat though, having only one spouse on title can affect financing eligibility. So if you're thinking about putting just one spouse on title, please check your financing options first with Carly, as it'll just involve their income, their credit score, their down payment. Next slide. So buying from the US without viewing and choosing the right home. I get asked this question all the time. Can I really buy a home from another country without setting foot in it? The answer is yes. And technology makes it doable and realistic. We have a whole toolkit for that. For example, we do live video walkthroughs where I have you on a video call like FaceTime or WhatsApp video. We have detailed 3D Matterport tours of the home where you can actually even take measurements of certain walls and see if things fit. And you can walk through the space. All offer signing is now electronic and done through DocuSign or AuthentiSign. So you don't need to be physically present to write an offer. You just need to have access to Wi-Fi and email. Your inspection, your strata documents review, your subject conditions, financing can also happen when you're not physically present. So being able to do your due diligence thoroughly virtually is still an option. One caveat I will say is that it's best to know the areas so you can pick the right neighborhood for your lifestyle. That means matching you with the right neighborhood based on your daily commute, schools, transit, and long-term resale value, not just the listing photographs, not just the listings that photograph the best. So for example, Greater Vancouver has so many different areas and each offers something different. So knowing those neighborhoods is vital to ensure you're purchasing the right home. Another caveat, if you've never been to Vancouver or whatever city you're moving to, I typically recommend that you rent in the area you're most interested in for a short period, generally around 3 months. It lets you learn the neighborhoods and see what money actually buys before you commit to a property, which is a long-term asset and can anchor for your day-to-day life. If you're familiar with the neighborhood and know the city you're relocating to, then you can definitely purchase virtually. But if you're unfamiliar with the area and have never been in person, renting first usually leads to a better fit purchase unless you already know the neighborhoods well. Next slide. And fitting the taxes into your purchase budget. So Sonia gave you a deep dive on the taxes and regarding on how they actually land with closing costs on a resale home, budget roughly around 1.5% to 4% of the purchase price on top of your down payment, on top of your purchase price for closing costs. That's mostly property transfer tax, lawyer fees, and things like that. A quick note is on GST. So on resale homes, GST does not apply. However, 5% GST does apply to brand new or substantially renovated homes and is 5%. There is a first-time homebuyer's exemption for GST up to 1 million, but the requirements are very specific and often newcomers to Canada do not qualify. The good news is that resale homes, even ones that have been occupied, let's say for a year or a short period, generally don't carry GST. So even a slightly used home can save you a considerable amount. And then lastly, there are what I call occupy it or pay taxes. In certain provinces, most commonly in BC and Ontario, there are extra taxes if you leave a property unoccupied. So for example, if the home sits empty for more than 6 months, you may owe additional tax. This includes, for example, BC has something called a speculation and vacancy tax, where you file an annual declaration. Municipality taxes like the City of Vancouver has an empty homes tax and others. Generally, the rule of thumb is simple: either occupy the home or rent it out for at least 6 months of the year, file your declarations and confirm your buyer status. Do these things and you're generally good to go. But again, it's very important that you consult with a legal expert to ensure you have crossed and dotted all our I's. And then finally, so lastly, I'll just leave you with this. Buying in Canada from the US is very doable with the right team of professionals around you. The rules are far more navigable than the headlines suggest, especially with a valid work permit. And softer prices make this a genuinely great time to be a buyer. If you have any questions, I offer no pressure consultations for free to walk you through your specific goals, circumstances, and timelines. And it's best to have these conversations early so you can start planning. I also can connect you with the right professionals, and my contact information will be at the end of the slide. So now that you have an overview of the real estate process, Carly is going to show you how you can finance this first home purchase as a newcomer. Carly, over to you.
Thanks so much, Shala. And yes, there's a fair bit of crossover between our two topics, so I won't repeat too much of what you've said there. But of course, we've got to start off with a little bit of hockey here, of course. And I'd like to jump into the importance of planning early. So I'm glad you ended off with that, Shala. So for the next slide, you might be used to getting pre-qualified shortly before you begin your home search in the US and even as part of your home search. But if you're moving to Canada, I'd encourage starting that conversation much earlier, because as we're seeing here in this webinar, there are a lot of moving parts. As soon as purchasing property becomes part of your relocation plan is really the time to start putting all the pieces together. So even if it's a few years away, you'll want to ensure that you're familiar with how your income might be treated, how assets are moved, how your overall financial plan comes together. And all of this is worth mapping out early. You'll just have more financing options available with more time left for planning. So you'll want to, as we've touched on, build your team. I won't spend any time in these areas, but in terms of your team, your mortgage consultant will also connect you with a few professionals at this point to ensure that your needs are adequately covered for all the pieces important to financing. Slide 3, please. The goal is to understand your budget really as you start planning for your property purchase. If you've purchased in the US, you'll know you're going to need to identify a comfortable purchase price range with down payment and mortgage eligibility in mind, down payment requirements, closing costs, your monthly budget expectations, including your mortgage, home insurance, property taxes, condo fees in advance. And instead of homeowners association boards, we have strata corporations, as Shala mentioned, who govern common expenses related to buildings and sometimes neighborhoods. So next slide. Running advanced scenarios will help you move more quickly once you find a place to purchase. It's important to get an upfront, very in-depth analysis to see what best positions your application for approval, as sometimes paying off debts or having a higher down payment might allow you to qualify for your target purchase price, or you might not know what your target purchase price can be. So we'll help you set a comfortable range. Your mortgage consultant will help you gather your mortgage application documentation. And in Canada, the rules can be quite stringent depending on the lender. The analysis of all of this just leaves less room for surprises once you begin shopping or apply for a final approval. It leaves more options open and helps you make better decisions before you're committed to a purchase. And that phase can move quickly. So for pre-qualifying, what does it actually take to qualify for a Canadian mortgage? The fundamentals are familiar. Income and credit and assets and debts matter, but some of the qualification rules are different in Canada. Affordability is determined calculating income versus your housing costs and debts, as in the US. And yes, your US credit report will support your application. I'm sure many of you will be happy to hear that. US buyers can qualify without moving to Canada as well. So foreign income, as it's termed by some of our lenders, including investment income, it's allowable as well for principal residences, second homes, and even rental properties through some of our lenders. Some lenders simply require verification via employment letters and pay stubs or income reported on US tax returns. And of course, US buyers moving to Canada can also qualify with US-based investment income as long as the income can be verified with US tax returns. With some lenders, I'd have to qualify that. Some lenders require US income to be deposited into a Canadian bank account. Others don't. Some require it to be claimed on the Canadian tax return, even if it's not taxable in Canada. But at a minimum, some lenders want to see that income at least being reported here. But that doesn't apply to everyone. There's quite a range of requirements, and depending on the type of loan you're looking for, there's generally options for everyone. Where assets are used to qualify, that gets tougher. Lenders usually require those assets to be held in Canada, and some require them to have been in the country for a certain period of time. This is the perfect slide. Thank you. For qualification rules is next here. If we can go back one. Thank you. So for eligibility, for those moving to Canada, as we've mentioned, Canadian citizens, permanent residents, and work permit holders' incomes may be used towards qualifying. And yes, Shala is correct. Work permits need to be valid for at least 183 days, so half a year after closing, and with other lenders, up to the length of the term they're qualifying for. So it might be that if you're taking a 5-year term, you might need your work permit to be valid that long. But we have shorter term lengths as well. So it might be just a 1-year mortgage that you're requiring. But there's some planning around that would be required, because you want to know that upon renewal, you'll have options, and what those options might look like will vary depending on your status here in Canada. Income can be assessed for various borrowers differently. Some professionals, such as physicians and executives on a transfer program from a large corporation, might qualify immediately under certain lender programs, whereas other new Canadian employees have to wait for 3 months after they've started their full-time employment here in Canada if they're on salary. And some lenders require 3 to 6 months. Variable income earners can face longer periods. Self-employed, hourly, overtime income, those who require bonus income to count towards their application, or commission income earners, typically require 2 full Canadian tax years before they can apply. Exceptions can sometimes be made for shorter timeframes, but it's file dependent. And income qualification, as you can see, is pretty nuanced. So as this varies case by case, you really do want to have an in-depth conversation with a mortgage professional before you make any assumptions. So next slide, please. Unlike the US, Canadian mortgage terms are typically 5 years or less. And we had a question from Diane on that, so thanks for that. You do choose a new rate and term at renewal. You can have a term of anywhere between 1 to 5 years. There are longer terms available as well, but you might not benefit from a lower rate for as long as you can in the US, for example, but you're also not locked into a higher one. Our terms are subject to penalties if you break them. There are some ways around that, and there are some ways to mitigate those penalties, but rates are generally lower here than in the US because of those shorter terms. Lenders don't have to hedge for as long, so they don't need to price in as much risk to cover their cost of funds for quite as long in Canada. And one of the other biggest differences is between Canadian and US mortgages is the ironically named mortgage stress test. You qualify with the stress test at 2% above your actual mortgage rate. And the irony comes in that it actually reduces future stress, because it ensures that you can still comfortably afford your mortgage if rates are higher at renewal, assuming your income and your debts haven't materially changed. Consequently, mortgage default rates are lower in Canada due to the stress test and a few other factors limiting house flipping as often as it might be done in the US. So for next slide, down payment, mortgage insurance, and amortization. Purchases with less than 20% down require mortgage default insurance like in the US, and many permanent residents and some work permit holders can purchase with 5% down at a minimum for a principal residence or a principal residence with a suite or for a second home. But we have a price cap of up to 1.5 million. The minimum down payment on eligible applications would be 5% of the first 500,000 and 10% of the portion between 500 and 1.5 million. And generally, your amortization is going to be 25 years on those insured mortgages, unless you're a first-time buyer or unless you're a buyer of a newly built home. With less than 20% down, you're eligible for an insured low down payment mortgage with a 30-year amortization, provided the house provided the property is owner occupied. And greater than 20% down payments are eligible for up to 35-year amortizations with some lenders, but those are more specialized. Typically, you'll be at 25 to 30 years on your amortization at first. Rules really vary by lender, and not all lenders operate in all geographic areas. So next slide, regarding down payment verification, we have strict anti-money laundering requirements here in Canada. Lenders really need to verify where your down payment came from, and they'll review up to a 90-day history of the funds, even as those funds have transferred through other accounts. And the deposits into those other accounts will also have to have some source that's verifiable. So any accounts your funds have passed through in that 90-day time frame, some lenders are shorter and some mortgage requirements are shorter timeframes, but even if the deposits into those accounts aren't being used for the down payment, they still need to be verified under our anti-money laundering laws. The best practice is to hold your funds in an account with as little traffic in or out to keep the verification process simple, if at all possible. But I know that's not always the case. Foreign funds, so funds coming from outside Canada, need to be in Canada for some lenders for up to 45 days before completion. So you'll want to have a plan to bring your funds into a Canadian account in that time frame. Some lenders it's less, but 45 days would be a good rule of thumb. And it's key to plan your down payment strategy early here. So next slide. Before writing your offer, just know that your pre-qualification review is an estimate. It estimates how much you'll qualify for. It's not a firm approval. You'll want to also know how to make your offer so the process proceeds smoothly. Some of the ideas we'd look at with you as a mortgage consultant is just what strategies might be available to save on interest, how you might maintain financial flexibility over time, and to coordinate mortgage strategy with your long-term plans. How the financing application process works once your offer is accepted is important to keep in mind as well, and what to keep in mind to ensure your approval proceeds smoothly is also going to be a factor. So Shala touched on some of this, so I'll just ask for the next slide. In writing your offer, as she mentioned, the offer will include contingencies or conditions as you're used to, and we call them subjects. The subjective financing period she referenced is a little shorter. I regularly see 5 to 10 business days, allowing time for the lender to review before you pay your non-refundable deposit and you commit to the purchase. And as Shala mentioned, deposits are typically up to 5% and form part of your down payment. Gathering an insurance quote at this time is also recommended because it will be a lender condition of financing for detached homes. And in the case of condos, that still forms part of your monthly budget as well. And the cost can vary quite a bit by building. It interestingly can be settled 2 months in advance of a purchase, which I recommend because that will be a lending condition that does have to be met before financing is advanced. And most often, a lender appraisal will be required as well, determining what the property value is. And that can take a number of days within that subject to financing period. So ordering this early is important. Inspections are separate from the appraisal. The appraisal is evaluation, the inspection's for you, and sometimes an inspection can impact the purchase price if there are deficiencies you want to be reimbursed for out of a lower purchase price. But that will change the contract, and the contract changes must be reviewed in advance by the lender because it will form part of their approval as well. And once the lender confirms you've met all of their conditions and you can decide if you'd like to lift the subject of financing, you can go ahead, provided the other subjects have been addressed as well. So next slide, please. Working towards completion. Again, Shala mentioned 30 to 60 days and sometimes up to 120 days, a 4-month period can be common. In this time frame, your mortgage consultant, your lender, your insurance provider, and your lawyer all work together to ensure your transaction completes on time. And at completion, you'll pay the remainder of your down payment and your closing costs, including your legal fees, property transfer tax as applicable, adjustments for city property tax and condo fees, if those apply, will be repaid to the owner for the portion they've prepaid. If you become the owner and they've prepaid for a portion of that, you repay them. And most lenders don't charge an application fee. In most cases, they actually compensate the mortgage consultant unless more specialized lending is required. And if that's the case, our office would charge a fee, and sometimes the lender does as well, or vice versa. Next slide, please. So your mortgage over time. Once the property is yours, it's helpful to understand that in Canada, your mortgage is something you'll revisit over time, more frequently than you might in the US. Your terms are typically 3 to 5 years, and you'll pay a penalty, as I mentioned, should you sell or refinance or prepay more than 10 to 20% of the opening balance in advance, depending on the lender. And you choose a new rate and term at renewal. In terms of fixed rates like in the US provide payment certainty, but at times can involve significantly higher penalties if those are broken early, if those terms are broken early. And in the case of variable offers more flexibility because penalties are lower with those, but of course, without the certainty of what your rate will be for your term. Essentially, it's important to evaluate the combination of rate type and term based on your goals and market conditions and the interest rate outlook when making your selection. So next slide. Thanks. Renewal at the end of each mortgage term is a great time to pivot as your phase of your career might change or financial goals change. You can use that opportunity to make adjustments without penalties at that point. You might just use renewal to compare lenders and save on interest with a more competitive rate, or you may change the structure of your mortgage to suit your future plans if those have changed by then. Adding a line of credit sometimes helps. You're used to those in the US for renovations or deposits for future property purchases as 2 examples. You'll want to just make sure that your mortgage still fits your goals at that time. And next slide. Mortgage features. So not all mortgages are created equal in Canada, just as in the US. Interest rates are important, but the features built into the mortgage also will really assist with the value. Lines of credit, prepayment options, being able to prepay portions without penalties sometimes can really matter. Portability allows you to move without penalty before your term ends in other cases. You do need to requalify to do that, but not all lenders allow that porting. So if there's a chance that you might want to move the mortgage before the end of your term, it's important to understand what your mortgage comes with in that regard. And opportunities may exist to keep co-borrowers financially further ahead if more than one borrower is on the mortgage. Retirement strategies can factor later in your career, and options can affect the overall value, regardless of which side of the border you're borrowing. So lastly, I'd like to invite you to download my free mortgage app. If we could have the next slide, please. Let's see, there we go. Oh, one more back. Thank you. It's a helpful planning tool, whether you're just starting to explore a move or you're actively preparing to buy. Income qualification can be really complex on these files, so the pre-qualification on this app doesn't replace a personalized mortgage assessment done by an experienced mortgage professional, but I certainly recommend a thorough review before relying on any estimate. But the app is simple to use and can assist with general pre-qualification as a starting point. It can calculate mortgage payments, closing costs, mortgage insurance costs, rough income requirements, property transfer tax across Canada as it varies by province, scenario comparisons as well. And if you add your email address when you first log in, it unlocks all the features for you. And the link will be on the resources page with my contact information. It's also on the next screen. There's a QR code here you can scan to have it download. But with lender policies always evolving, I'd be happy to have an early planning conversation with you to help you navigate from there. And even if your move is still a year or two away, it's never too early to start planning. The consultation process is free, and I'll identify an estimate of fees so you can decide if you'd like to proceed once we complete our review of your options. And that concludes my portion of the presentation. I welcome any questions too. Thanks so much.
Thank you, everyone. Ladies, this is really extremely educational, very in-depth. So everyone should know that we will be sending out a recording so that you can follow along again. And I want to say there's another resource here that we've sharing with you. Amelia Cotto of CISO Legal is a duly licensed immigration attorney. You can reach out to her and she may have referrals if she's not available. Here are our contact information. So your move to Canada book at gmail.com for Sonia, Shannon at Canadiana Fest, that's Shannon with a C, and Shala Bakar, homes at shalabakar.com, Carly Shee, Carly at carlyshee.com. And I would like to just take a moment to be able to share with you a little bit about what we do here at Canadiana Fest. Thank you so much, everyone, for your patience. So people ask me, what is Canadiana Fest? I mean, it sounds like a party with Canadians, and it absolutely is. We are a celebration of all things Canadian in the heart of the Midwest. We're a grassroots 501c3 sponsored project of STARA. We're here to support the Canadian diaspora and the communities that they live in and all the people around them with education, culture, and at this time with kindness. We absolutely need a lot more of that. We are a group of like-minded volunteer Canadians, Americans, Canadian-friendly, curious, and adjacent folk who want to celebrate the culture of their neighbors to the north. It's been obviously a big thing in the news about some challenges that we're experiencing between these neighboring countries. And so we're here to create a joyful celebration. And we do that on September 19th with our flagship festival, the Can-Am Peace Jam. It happens in Kalamazoo, Michigan. So we're in the heart of the Midwest. We're kind of in the middle of the country. And we've been doing this now. We're coming up on our 4th year, and it's been doubling in size every year. Who knows what this year is going to bring? It's going to be a heck of a lot of fun. We have 7 bands. I counted them out. We have 7 entertainment artists, including Melisande from Montreal. Her and her band are award-winning Acadian musicians who vamp it up and have a lot of fun, even doing a blacklight show. It's absolutely amazing. And Henry Sir, who is a Canadian comedian from Edmonton, very saucy guy, and he's going to be our guest MC for the day. So much fun, so many other things. Please check us out at canadianafest.fun. If you would like to support the organization, you can always do that by buying tickets, even if you can't come. But if you can get in here, we have an airport just up the road, right in town, and we've got some great deals at the Plan Your Visit page on our website. So I just wanted to now take a moment and see if we have any questions, I'm going to stop my share and jump over to the chat and see what we have. I know that we've already answered quite a few questions. So the first one, oh yes, I will just note, I tried to download the app and it said not available in your country. So
Oh, shame.
yeah,
Should be.
darn. But I'm sure there's got to be some way around that, Carly, and
There may
obviously
be a workaround. I'll check in with my provider.
let's see. And we can always put those notes in our follow-up and on our website when we upload the video in our resources page. We'll make sure that that sort of thing is addressed. Let's see if there's any other questions. We've got an email, a couple of, yeah, people are just noting that the app won't open on the phone.
Okay.
Same deal. So here's a question. Is it possible to avoid the APTT in BC with a work permit when purchasing in Nanaimo RD?
Nanaimo?
Nanaimo. Sorry, did I say that? Oh my God, how can I say
It's a hard one.
Nanaimo? Yeah, but well, you know why? Because I say Nanaimo bars. I've always said Nanaimo bars. Everybody know what a Nanaimo bar is? It's heaven.
Nanaimo bars are
That's
the
what it is.
best.
Heaven. It's heaven. We'll tell you about it another time. Come out and have some at the festival. So can someone address that question for, let's see, that's Greg.
Yes, so if you have a work permit and you're relocating to Nanaimo, there certainly are lenders who will lend there. Just reach out and I'd be happy to discuss your situation.
Okay.
Yeah.
Are there any special considerations for retirees?
I could take
Most
that one.
definitely. Yeah, go ahead, Sonia. I've got a few comments too.
Yeah, and a lot of it, me and Carly were going back and forth on this a lot, just preparing for this presentation and saying how, a lot of the people moving are retirees. Um, and a lot of what we were talking about, Carly, was a lot of retirees may not have income in terms of employment. So that can, make things a little bit harder with the mortgages. And also, a lot of the assets that are held by retirees are US retirement accounts, which don't come to Canada. And again, the other webinar in my book talk about a lot of that in detail. So, something to consider is what is going to be your income limit a level in Canada. So from an income perspective, if you are receiving, let's say US Social Security or IRA or 401k withdrawals, that is going to be taxable in Canada. So it's reportable on your tax return, but it's not necessarily an asset that can help towards a mortgage. And then I'll let Carly touch on that. But before I say that, what I will add is a lot of people to put towards a home, they want to withdraw from their 401k. I would just do a very special caveat or just keep in mind that that's taxable. So taxable income in the US for sure. If you withdraw in Canada, it's also taxable income in Canada, perhaps at a higher rate. If you're going to go with that approach, might make sense to make that withdrawal before you become a Canadian resident. And if you're age 59 and a half, that withdrawal could trigger an extra 10% penalty tax. So that's important things for retirees. Carly, what would you want to add to that?
I do, depending on whether if you have a co-borrower or not, some lenders are more amenable to co-borrowers being able to continue with their borrowing and their financing if something were to happen to one of the borrowers. There's something called right of survivorship. So with lenders that have right of survivorship, if somebody loses a partner and they're on title together, right of survivorship means that your financing continues without interruption. But some lenders may need you to requalify at a very difficult time. So it's important to know what kind of lender you're with going into retirement. I also typically recommend people qualify for a line of credit if that suits them. Not everyone wants one. Not everybody trusts themselves with one. But if you do, I do recommend setting up a line of credit before you retire because you'll qualify for more with income than you will with assets later. And then when it comes to US borrowers, who are moving to Canada, yes, it can be tricky to qualify with assets unless they are held here. But if you have assets generating investment income, you may qualify for a mortgage on that basis, even if that investment income is earned in the US and taxed in the US, but you're using that to qualify for a Canadian mortgage. Lots of different nuances depending on the borrower, who they are, how they're earning income, and where those assets are held and taxed. Happy to sort through that with anybody who
and what I'll add to that, Carly, is even though like if your income is in an IRA or 401k, that generally stays in the US. But if you have like a non-qualified or taxable brokerage account, generally that could be moved to Canada, and oftentimes it might make sense to move those to a Canadian brokerage for a number of reasons. And if there's just stocks, like individual stocks or ETFs, those could generally be moved in kind without triggering any taxes. Mutual funds could be a bit more tricky. But so there are options. But again, it just kind of reiterates why you want to do this well ahead of time, because if that lender needs those assets to be in Canada for a couple of months, then you need to kind of initiate that transfer ahead of time. And if that lender does need assets in Canada, have those assets there and then qualify. So definitely important to, do the planning well ahead of time because there's lots of moving parts.
That's right. In some cases, those assets need to be here for a year or more as well.
Yeah.
So good to have the conversation very, very early.
Excellent, lady. This is why we do this, right? It's a big change, and there's so many nuances, and I love working with these professional women who are just on top of their game. I wanted to mention that one of our guests, Brent, he said he was able to download the app on a phone without active phone service. Your mileage may vary. Hope it helps someone. Thank you, Brent.
Thank you, Brent.
So if you have an old phone laying around, anybody got a flip phone? No, they didn't do that anyway. Anybody remember those? Geez, these are big. So I think that was the last of the questions. Sonia, Carly, Shala, is there anything that you would like to add before we say goodbye to everyone and get this all wrapped up?
I have a comment. So for Brent, so anybody who wants to try to download the app, perhaps if you disconnect from your cellular service and just be connected to Wi-Fi when you try to download it, that should be the workaround.
Excellent.
And Christy was able to download it with Google Play. Thank you, Christy.
Oh, wonderful. That is excellent. I'm glad to hear that. Well, with that, I would just like to thank everyone for joining us today. We hope that you'll find the other resources on the Canadiana Fest website to be helpful to you. I do especially recommend the one that we did with Sonia and Clark. It was very in-depth and complements this topic. And if you have other topics that you would like for Canadiana Fest to put together a panel of specialists to bring and share with you, please reach out to me. We are interested in doing this more often. There are a few ideas I have, and but of course we'd love to hear from all our other Canadian brethren and those who are Canadian friendly, Canadian curious, Canadian adjacent, and sometimes even Canadian envious. I will say it. So with that, I would like to say goodbye to everyone, or so long, and hope I see you in September. I think there's a song about that somehow. But again, merci, miigwech. Thank you. Bye,
Thanks, everyone.
Thank you. Thank you, everyone.